Why is the gross rent multiplier important for rental investors? Imagine being able to quickly tell if a rental property is worth considering without digging through endless financial statements. That's where the gross rent multiplier comes into play. It's a simple number that helps investors see the relationship between how much a property costs and how much rent it can generate. When you're just starting out with rentals or doing a rental market analysis, this tool can save you time and help make smarter choices. The gross rent multiplier is calculated by dividing the property's purchase price by its total annual gross rental income. For example, if a property costs $300,000 and brings in $60,000 a year in rent, the GRM is 5. That means it would take 5 years of gross rent to pay off the property's price. This quick calculation gives you a rough idea of how long it might take to recoup your investment through rental income alone. This number is especially useful when comparing different properties in the same area. If one property has a lower GRM than another, it generally means it can generate more income relative to its price. So, a property with a GRM of 4 might be a better deal than one with a GRM of 6 because it could pay for itself faster. It's a handy way to filter out less promising options early on. Another reason the gross rent multiplier matters is that it doesn't require detailed expense data. You don't need to know the exact costs for property taxes, insurance, or maintenance to get a quick sense of value. It focuses solely on gross income, making it easier to do initial screening. Think of it as a first step before diving into more detailed financial analysis, like calculating the capitalization rate, which takes expenses into account. However, it's important to remember that the GRM isn't perfect. It doesn't include operating costs, vacancy rates, or financing expenses. So, while it's a good starting point, you'll want to use it alongside other metrics for a complete picture. It helps identify potential bargains or overvalued properties, guiding you toward better investment decisions. In practical terms, rental investors use the gross rent multiplier to spot undervalued properties or to set realistic price and rent targets. If you know the market's average GRM, you can compare properties quickly and see which ones might give you the best return. It's also useful for estimating how long it might take to recover your investment based on the gross rent. Overall, the gross rent multiplier is a straightforward, helpful tool that makes initial property evaluation faster and easier. It helps investors get a clear view of how rental income relates to property price, making it easier to choose the right rental properties to add to their portfolio.